Do you think the speculative era of crypto is dead?
I don't think so. Meme coins printed fortunes in 2025. That game isn't going away. But what changed is that, we now have crypto businesses generating real revenue from real activity, not just token appreciation.
This material is for informational purposes only and is not intended to provide accounting, legal, or tax advice, or investment recommendations, or an official statement of Presto or its affiliates.
Hello, everyone, and welcome back to the Presto Research Podcast. I'm your host, Min. Today, I'm joined by my colleague, Thomas. And we are doing things a bit differently this time. Usually, we have a project founders on the show, but today, we're excited to have Arhat, partner at Primal Capital. Great to have you with us. How are you doing today?
All good, man. So good to be here.
Yeah, you sound very excited. So I guess as usual, why don't we start with our
Yeah,
usual question? Tell me about your journey into crypto. What do you do at Primal and what you focus on recently?
go. So my journey in crypto was very orthodox, like unorthodox, right? I got into crypto because, I wanted to understand how money actually moves. I'm like very obsessed with economics, more importantly, like, how you make money and following that trade early. So, but it's not always just about tracking flows, right? Economics is like financial gravity. So, everything gets priced in eventually. So you're really participating in an environment where understanding how value moves through a system tells you where the opportunities are before it becomes obvious. And crypto was that space where you could do that literally, from the start. So before crypto, I was in private equity for a while, focused on real estate and TMT. It was solid work, but crypto fascinated me in a way that TradFi didn't. The transparency, the speed that markets repriced information, the ability to actually see capital formation happening in real time, that was just exhilarating. And then during COVID, I made the jump, worked with a family office in the Middle East, launched two crypto businesses of my own, learned a lot about what works and what doesn't. And especially from the operator side, and I eventually made my way to the VC side, starting with research, really trying to build a framework for how to think about the space, systematically. At Primal, we are an early stage venture fund. We look at pre-seed seed deals. We are very founder focused mainly. We have internal thesis about what sectors we like, but honestly, founders matter more. I really love working with people who are genuinely obsessed with what they're building, and you can tell pretty quickly who's here because they believe in something versus who's just chasing a cycle. So yeah, I mean that's what we focus on Primal internally, and yeah.
Nice, nice. So, let's start with the second question here. So, in crypto, we are used to chasing the narrative or funding a narrative, but now it seems more and more VCs are asking about unit economics and whether it actually makes money. Do you think the speculative era of crypto is dead?
I don't think so, not specifically, but I think speculation will live, but there's like a real alternative right now. I think for a very, very long time, the only crypto investment thesis was, fund early, hope the adoption comes, and exit when the token bumps. So that's purely speculation. And it still works. Meme coins printed fortunes in 2025. Poly market had a breakout here. That game isn't going away. But what changed is is that we now have crypto businesses generating real revenue from real activity. Not just token appreciation. We are seeing businesses make real operating income. So stablecoin issuers are a very good example. Tether made over, let's say, 10 billion profit last year, circled around like 800 or 700 million in interest income in Q3, and they're just earning interest on the float. Every dollar sitting in USDC, USDT generates yield for the issuer. The math is, very straightforward. There's like 300 billion supply, 4 to 5% in interest, and minimal operating costs. That works regardless of whether we are in a bull or a bear market. And DeFi is generating the real revenue too. And I think people really underestimate this. Like Aave made like 350 million protocol revenue last year, and that's from real interest from real borrowers with real yield from real lending activity. And Uniswap did around like 700 million in trading fees to LPs. Hyperliquid is probably the best example of DeFi protocol operating like a real business. They did 3 trillion in volume, 800 in revenue, and they're still profitable. Like they built something that competes with centralized exchanges on execution quality, and they are capturing fees from every trade. MakerDAO, Sky Protocol has been quietly running a profitable business for years. They are earning from stability fees on the stablecoin loans, from liquidations from the RWA portfolio. I mean, it's not exciting, but it's still, it still compounds. So me personally, when I look into this market, there are like two tranches that I see, or two different tracks that actually make sense apart from like the speculative environment or narrative that we've looked into. One is definitely, the infra side, which is, stable coins, lending protocols, exchanges, or derivative platforms. These have real unit economics. Revenue scales with users, margins are measurable, and you can actually underwrite them like you'd underwrite any fintech. And the second part is the speculation side. L1's competing on narrative, consumer apps betting on adoption, there's meme coins. There's nothing wrong with this, but the investment framework is completely different. And I might be biased from my side, but like on this approach, people are just betting on timing and momentum rather than, cash flows. And I think that was the mistake people made early 2021 as well, by confusing these two tracks. Like people applied infrastructure valuations to speculative plays. They expected revenue from things that were never designed to generate revenues. And what's actually healthy now is that, sophisticated investors, both retail and institutional, know which game they're playing. You can do both, and we certainly do, but you can't pretend a speculative bet is actually a cash flow investment. And that actually, sways a lot of people away from the speculative bet, but, everyone has their own preferences.
Yep. I guess one thing that I wanted to ask is, especially with the current market situation, people are saying like, hey, I mean, lots of VCs are going bankrupt and VCs are deploying less. Is it true? And also, can you just briefly talk about the current state of the venture capital market in crypto?
I think VCs they are deploying less, but at the same time, they are being very selective as well. But the real story is that there's a real structural reset that people don't fully appreciate. Most, like, let's take 2021 as a benchmark, right? Most funds back in 2021, 2022 were built for a specific market. The playbook was very simple. Deploy into as many deals as possible, ride the alpha, and exit via token launches, while retail is like fully pumped. But when everything pumps, your winners cover your losses. That's uh, there's nothing wrong with it. But that playbook assumed a very functioning exit market, and for a particular window, it worked, and then it broke. Token launches from late 2023 and early 2024 were like painful. Retail didn't show up. Projects launched and immediately traded below private valuations. One that had deployed into 50, 100 companies realized most of these positions were underwater and illiquid. So they stopped deploying, I think a few years, like recently, I'd say 10, 12, 18 months ago. It was not out of discipline, I would say, but it was a necessity for them. They had portfolios that needed support. They couldn't show returns to LPs, and raising new capital is always like very difficult. And this time it became nearly impossible. And right now, you have a smaller set of funds with actual conviction and capital to deploy, and they've conversed on a different approach. Like instead of betting on narratives, find businesses with real activity and defensible positions. That's why you see capital concentrating into custody, exchanges, derivatives, stablecoin infrastructures. Like these are the areas where you can measure usage, see revenue, underwrite with some confidence. And over time, the shape of the market has become like a barbell. Like, there's big checks going into proven infrastructure. Kraken's listing at a $20 billion valuation, Circle went public. There's, acquisition spree going on everywhere. So small seed checks are going into early primitives, and the middle primitive, which is be speculative or just invest in projects that could or could not go well, it's just dead. So from where I sit, right, the bar for traction has completely changed. Like, 5 years ago, you could just raise with a white paper. 3 years ago, you just with a testnet and some users. But right now, everybody wants to see actual users, and not just users, actual volume, actual fees, actual evidence that something is real is happening. But that's not like cyclical, I would say. Like, it would just keep getting better. People, because now VCs even realize, how do we actually make valuations justifiable. Like, in a few years ago, you would just be like, okay, 25, 50, 100 mil is justifiable. But now, there are some actual metrics in place that we do use internally, to justify these valuations. So some funds, go that way, some do not, but it's a fair game anyway.
So, since last year, we've been seeing a series of crypto businesses going IPOs in traditional finance market. Is this something we can see as a new normal, or is this just an exception? What do you think?
I mean, 2 years ago, if you would asked me, it was an exception. But now it's like a real path. But I think it would be only for like specific type of companies. But if you look into how the IPO markets work, right? What changed right now is that crypto businesses can now answer the questions public markets actually ask. Like, what's your revenue? How does that scale? What happens when the market turns? Circle can tell that story. They earn interest on reserves, revenue grows with stable coin supply, margins improve at scale. Kraken has multiple revenue lines across trading, staking, custody, derivatives, and these aren't token dependent businesses. And Circle's debut was very strong. Like, their equity like nearly tripled, and then the demand forced multiple trading halls as well. So that signals like genuine appetite from public market investors. Then we also saw like eToro, Galaxy, Gemini all list, and Kraken listed their filed their S1 in November. So the pipeline is real. And then, the regulatory environment has also been very helpful lately. Like, Genius Act passed, SEC dropped several lawsuits, and that created a window that VCs are trying to move through quickly. And that caveat that you see that, crypto, and that also forms a caveat that, crypto businesses still correlate heavily with Bitcoin. When the markets drop, these stocks drop harder. So it's not a clean exit from crypto volatility, but it's the right first step. And for businesses with actual recurring revenue, I feel like IPOs are still or are starting to look like a viable path alongside tokens and M&A. And personally, that's a meaningful shift from, let's say, 2 or 3 years ago, and that's actually in the right place.
Got it. And one thing that I want to talk about, especially with the current market, is even the CTs are all talking about AIs, right? And I guess most of the kind of focus or attention is kind of shifting to the AI, even in the crypto side. And is crypto competing against AI for the talent and money? What's your take on this?
I mean, on aggregate, yes. But crypto definitely is on the losing side for that trial. And that's because, AI doesn't need crypto to survive and vice versa. But if you look into the numbers, right, AI took roughly half or more than half of the all venture funding in 2025. Crypto was less than 10%. So that's a significant gap. And you see the similar story with the talent as well. If you're a strong engineer, the AI opportunities are compelling, the compensation, resources, the sense of working on something transformative. But I don't think that everyone who left crypto for AI was going to be a long-term crypto person anyway. People who stayed are here because they believed in what crypto specifically enables: open financial infrastructure, permissionless systems, and the ability to move value without intermediaries. There's also a question of like, what AI might actually need as well. So if agents are going to transact autonomously, they need financial rails that don't require human identity at every step. Traditional banking can't accommodate that. So that's why, crypto infrastructure potentially pops in. And most AI crypto projects today are early and speculative, but at the same time, the underlying premise that autonomous systems need permissionless payment infrastructure, seems very reasonable to me. So even if the talent is going out, they are eventually going to come in and look at crypto as the final way for them to get out and use that infrastructure, because I don't think it's a zero sum competition. There are different domains solving different problems, but the question is whether they eventually complement each other, and I think they do.
So, well, let's turn to your insights for the year. What sector or topic are you most interested in this year? Anything interesting for you?
Yeah, I mean, I'm very bullish on two theses, on two verticals that I really want to spend my time on. One is stablecoin infrastructure, and second is the on-chain derivatives. On stable coins, the issues are one, like Feather, Circle own that market. What I'm interested in this infrastructure is that enables stable coins to actually function as a global financial rails. Like, stable coins are at the top of the stack. There's like millions of other things that you can do within that space. The big unlock obviously is the cross-border payments and foreign exchange. So, today, if you want to move dollars from Singapore to Brazil, you are going through corresponding banks. It's, expensive, but right now you have infrastructure in place that works at scale, and TradFi infra doesn't exist yet. And even crypto is going into that space. So you need FX settlements layer, the ability to go from USD to stable coins to local currencies and back, and with proper liquidity and tighter spreads. So this is where I'm thinking there's a lot of value to be built on, and the companies that can offer that kind of reliable corridors with instant settlements would create significant volume. Right now, it's getting better, but I feel like the infra is not quite there yet. And the second thing is also we also need like treasury infrastructure, like corporates holding stable coins, the need to manage, foreign exchange exposure, earn yields on idle balances, and integrating with their existing finance stacks. So this is like a, Brex for stable coins opportunity. Like companies like Bridge with Stripe acquired are like early movers here. So you need compliant on and off ramps at scale, not the retail focused ramps we have today, but institutional grade infrastructure with like proper licensing across jurisdictions, bank integrations, and the ability to handle large volumes are the way to go. And I mean, I could go like on and on this thesis, but thesis simple, like stablecoin supplies like 300 billion and growing, transaction volumes are tens of trillions, and the infra to support enterprise use cases is like still being built. But that's the opportunity. And on the derivative side, I'm like perpetuals are where all the trading activity concentrates. So what interests me now is expansion beyond crypto assets. So in the same infra can support equity perps, commodity perps, FX perps as well. So the rails exist. It's how fast new asset classes get added and who builds the liquidity for it. So I mean that's basically what my thesis is for this year, and I want to go all in.
It's interesting that you don't mention prediction market as part of the Unchained derivative. Is that what's your take on prediction market?
It's still a it's still a very speculative bet for me, and that's just a personal view for me. It's just like it's not something I like. I'm not good at gambling, and that is something like you have to gamble on probabilities here and there. I've never looked at it as a proper like there can be a lot of prediction markets surviving side by side, but like personally I've always been very focused on like in actual businesses, like not to say that prediction markets are not actual businesses, but like stablecoin infras and on-chain derivatives, which generate a lot of volume, because volume is where the money is, and that's where the best opportunities lie to make money and revenue. And actually show that that's a revenue generating business. So I mean that's a personal preference. I haven't like really dived very deep into prediction markets, the future of prediction markets, the use cases that you can generate with it as well. There's been a lot of talk about using prediction markets insurances, but that's still speculative. Like, how do you make it work? So I mean, it's still imploding at the moment, but how does it actually grow? It's still a very big question for me. So it's not something that I have certainty in. And until I have that, I don't want to focus on that at the very least.
Do you think the parts that you mentioned, like stablecoin infra, those needs a token?
I don't think so. I mean, it's just a preference. I would not like anyone exploring like a token infra for like stablecoin issuances, because they are eventually like competition for TradFi. But it just like, how do you justify like utility for that business? How do you justify like the appreciation for a token that's only gonna be a speculative bet? Share prices increase, equities like see a lot of increase because the concentration and holding is very concentrated, and at the same time no revenue gets distributed. On the token side, you do not get any access to that, at the very least, with the current market that we are living in, and also the retail is very judgmental at the moment. So I do not think so. Very speculative, but who knows? In the future we see more broader tokenomics come in. Let's say with proper regulation, that would be a very viable option, very preferable as well, given that not everyone over the world can trade all the stocks listed anywhere. But yeah, I mean, eventually we will see that if happening, but I don't think they need a token right now. Markets will eventually. I mean, markets will eventually price them in on what's happening around. So
I guess talking about utility, this is just a random question, but do you have any thoughts on the buybacks? Is it necessary or
no, I think they are useless. They are not a token utility, like real token utility. Like, why are you spending all your money on buying a token when you're supposed to build real utility for it? So I've never seen them as a real use case to generate long-term revenue or even long-term appreciation for a token. I don't think it will ever be that way. So I'm very biased on that. Like, buybacks are never a real utility.
So it seems like you seem to think that crypto tokenomics will eventually follow the logic of the TradFi, where you only
Yeah.
return your capital when you have no better use to it, right? So buybacks are returning your capital to the holders.
Yeah.
Crypto works the same way as TradFi. Is that what you think?
I mean, eventually that would be the goal, right? Be permissionless without borders. Everyone uses the same. There's no restrictions. You and I don't have different rules for how we transact on chain. TradFi was built to make it easier, but at the same time, borders complicated a lot of things. Crypto, like, the real belief that, crypto and blockchain evolved was that, everyone was equal. You cannot expect UBI to be a thing when borders, regulations, and financial systems operate on different goals and different roadmaps. So I think I really do believe that's eventually the end goal, and that would end up happening. I'm very certain. How long it takes, who knows? We aren't going anywhere. So even if it takes like 10, 15 years, that would be a very, very good outcome to look for.
yeah, and I guess almost our last question will be, is there any controversial opinion or contrarian bet that you're bullish, or even something other stuff that you want to mention here?
I mean, I stay away from controversial bets, honestly, because it's very hard to defend. I do have somebody, I would stay away from it at the moment, but something that I'm very, very bullish and I think are gonna get some more traction is like on-chain commodities. Like, I've spent some time with a few friends of mine, who run hedge funds, and they specifically uh integrate and work within the CFD space. And over the past 6 7 months, I've looked in the space, and it shows that it's like it's an insane market, and the house plays against you to win. So on-chain commodities, on-chain CF, like in that CFD space, that's a very big market that I'm very bullish on. The setup is very real. Retail traders globally who want leverage exposure to, let's say, gold, oil, FX, mostly go through CFD brokers, IG Group, plus 500, CMC Markets. These platforms are like charge 20, 50 basis points in spreads. On-chain pop infrastructure can offer the same exposure, like 1 to 2 basis point, the same spreads on commission, and at the same time, you do not like pop's platforms, will not bet against you. They want you to win. They want you to trade more because that's how they make money. And the question right now is like, why hasn't this happened already? And I think that the answer has already been. Answer has always been the distribution and regulatory ambiguity. CFD brokers have spent decades building retail distribution channel, and they're licensed in dozens of jurisdictions. On-chain alternatives are very new, unfamiliar, and like until recently, like operated in a very gray zone. And what's changing is like the regulatory picture is clearing up. There's stablecoin legislation passed. Everything that we talked about before.
Oh, I was just trying to ask, do you have any bullish ecosystem that you have in mind?
I mean, right now I track the hyperliquid HIP3 ecosystem a lot. Like, I've gone all in onto trading, like equity perps, commodities on Ostium recently. That's like a huge trading environment for me as well. Yeah, I mean, like I trading, like trading something on the TradFi space is very easy to do because have a lot of resources and opinions, and you can just aggregate all of that into something that you can believe in. So that's like but yeah, I mean that's why like I'll be focusing more on hyperliquid HIP3 and more like commodities trading as well, because that's what I used to do previously as well. When I was a undergrad and masters, it was very easy to speculate on cyclical bets, what's going to happen on the winters, during the summers, who's going to buy the steel, what's happening to gold during occasions.
Yep. I guess before we end our podcast, I guess for listeners who wants to learn more about Primal Capital or who wants to reach out to you for, I guess, investment advice or anything, what's like the best place to reach out to you guys?
I mean, just reach out to me on Twitter, on OXR, that's my handle. You can also reach out to us on LinkedIn. I'm always terminally online on Twitter. So, if you tag me, send me a message, send us an email or LinkedIn, I'm always there. So, I mean, it's very easy to reach out to me, honestly. So, yeah, just text me wherever. Yeah.
Okay, I think this is it for today's podcast. Thank you, Arhat, for sharing your insight, and see you guys all next week.
All right. Thank you guys for having me. Bye.